Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know, first, as China's economic war playbook proves effective, Europe eyes its own leverage with $8 trillion in US assets and Dutch chip tech. We'll analyse why this strategic shift matters now and how Europe's potential retaliation could trigger a surge in US Treasury yields and disrupt global tech supply chains. Second, the Takaichi trade sends Japan's Nikkei past 54,700 but crushes the yen, raising fears of a UK-style bond market crisis. We'll examine how this high-stakes fiscal policy creates a major dilemma for Japan and how it may impact global currency and bond market stability. Third, at one point, £2 million per day, the UK's British Steel bailout becomes a test case for the West's price on national security against China. Today, we'll take a closer look at this costly industrial standoff and its implications for future UK-China investment relations and Western industrial policy. In the West, you have the notion that if somebody hits you on the left cheek, you turn the other cheek. In our culture, we punch back. That was the stark warning from Chinese President Xi Jinping, and it's the core of a new playbook on how to survive an economic war. A former State Department official has broken down how countries are successfully pushing back against sweeping tariffs and economic coercion, and the lessons are shaking up global strategy. Actually, this playbook is becoming more effective because the world is changing. For decades, the US market was seen as the ultimate pot of gold for exporters. But research shows the US share of global imports has been slowly declining. This means its economic leverage isn't what it used to be, and other nations feel more empowered to push back when threatened. This fundamental shift in global economic power is the backdrop for the entire story. It's a three-step counterattack: resolve, resilience, and retaliation. First, resolve. When India was hit with a 50% levy, its Prime Minister, Narendra Modi, refused to back down, declaring India would never compromise its interests. The public rallied, boycotting American products, and businesses refused to cut prices. The pressure campaign eventually fizzled out. Second, resilience. When Brazil was hit with steep tariffs, it didn't scramble to appease the US. Instead, it moved fast to reorient its trade by finding what some analysts call a geoeconomic safety valve. This strategy works because when one major market tries to close its doors, another one opens. Shipments of beef and coffee were rerouted to China and Southeast Asia, and the numbers here are staggering. In 2025, trade between China and Brazil hit a record $171 billion. This surge was driven by massive Chinese purchases of Brazilian goods like soybeans and iron ore, effectively blunting the impact of US tariffs. The result? Brazilian exports hit a record high while US consumers face rising prices. And this isn't just a temporary blip. The knock-on effect is that it can lead to higher, more persistent inflation in the US. When American companies can't easily find substitutes for goods from a tariff country, they have to pay more. And who ultimately pays that price? The consumer. In fact, one study from the Kiel Institute found that US consumers and importers bore a staggering 96% of the tariff burden, with foreign exporters absorbing almost none of the cost. Continuing our last discussion, Washington hasn't relied on tariffs alone. A while back, we talked about the government becoming a direct shareholder in companies like Intel and US. Steer what's been dubbed the Lutnick Doctrine to cut reliance on China for critical minerals and Taiwan for semiconductors. The aim is resilience, but research suggests it can create protected yet globally uncompetitive players, keeping costs elevated rather than bringing them down. But the final step is retaliation. After being hit with tariffs and tech restrictions, China unveiled its own plan. It didn't just match the tariffs, it weaponized its control over the global economy. Beijing cut off America's access to rare earth minerals, a market where it refines 90% of the world's supply. As we noted a while back, Chinese refined rare earths are estimated to be 5 to 6 times cheaper than Western output, which is exactly why replacing those inputs domestically pushes costs up fast. And we're not talking about obscure metals here. They are essential for everything from smartphones to advanced military hardware. The US is heavily dependent on China, not just for these minerals, but also for critical services like semiconductor assembly. The impact was immediate. Companies like Ford and Suzuki were forced to close factories, and trillions were erased from the US stock market. Now, Analysts are pointing this playbook directly at Europe, noting it holds its own powerful cards. European investors own $8 trillion in US stocks and bonds, and American ambitions in advanced semiconductors would crash without Dutch chip-making equipment. For Europe, that intersects with what we discussed earlier. Washington's new industrial posture signals it's willing to absorb higher costs for self-reliance, which raises the stakes in any transatlantic standoff. So, what does that mean in practice? That $8 trillion in US assets represents a latent financial choke point. The threat is potent because if European investors were to even threaten to sell off a significant portion, say just 10%, it could trigger a surge in US Treasury yields. Rising yields would increase borrowing costs for the entire American economy, from mortgages to corporate debt, creating a powerful deterrent against aggressive trade policy. And on the technology front, the threat is even more specific. The Dutch chip-making equipment refers to a company called ASML, which has a near monopoly on the extreme ultraviolet, or EUV, lithography machines needed to make the world's most advanced computer chips. Without access to ASML's technology, US leadership in semiconductors would be severely threatened. The analysis is clear. Economic threats don't just go away. They only stop when they become expensive. So what's next? The key focal points to watch are the global trade flows. Are more countries diversifying and building non-US centric supply chains? Also, keep an eye on any policy statements from Europe about its strategic choke point technologies, and watch the US Treasury's data on foreign holdings of American debt. These indicators will tell us how this new era of economic pushback is evolving. Speaking of high-stakes economic gambles, let's turn to Japan, where a political earthquake is sending shockwaves through the market. The Nikkei 225 index just shattered its all-time high, rocketing past 54,700. This isn't a random market surge. It's the direct result of Prime Minister Sanae Takaichi securing a landslide snap election victory, the most decisive win for her ruling party since 1996. So the thing is, this victory signals a potential shift away from the Abenomics of the past decade, which focused on broad-based monetary easing and stimulus. Takaichi's administration is emphasizing a more targeted strategy of responsible and proactive fiscal policy through strategic investment in specific high-growth sectors. This victory fully unleashes what traders are calling the Takaichi trade, a high-stakes economic strategy that is splitting Japanese markets in two. On one side, stocks are euphoric. Sectors like defense, artificial intelligence, and chips, all singled out by Takaichi for investment, are big winners. As one analyst at Daiwa Capital Markets put it, the stock market is a true believer in Takaichi. This move also deepens the geostrategic fragmentation of global technology. Takaichi's focus on AI and semiconductors signals a major strategic pivot to fully align with the US tech blockade against China. The government has announced plans to provide over 10 trillion yen in support to triple domestic chip sales by 2030, a decision that could force a costly realignment of supply chains for both Chinese and Western firms. But that's not the whole picture. On the other side of this trade, the yen and Japanese government bonds are getting crushed. Since Takaichi became Prime Minister, the yen has been punished, losing about 6% against the dollar and hitting record lows against the euro. What we're seeing is a classic macroeconomic dilemma. The prospect of massive government spending weakens the yen, but a falling currency has its limits. The market is now watching the USD JPY exchange rate like a hawk, specifically the 155 level, a historical red line for intervention. Some analysts believe Japan's Ministry of Finance might tolerate a slide to 158, but if they are forced to step in to defend the currency, it could signal a major shift in global policy. The situation is even more precarious in the bond market. The prospect of more government spending, funded by more debt, has investors on edge, as Japan already has the largest debt burden in the developed world. Those fears recently came to a head when rates on Japanese government bonds shot to multi-decade and in some cases all-time record highs. This is where it gets interesting because it brings up the terrifying ghost of the UK's Trussonomics crisis in 2022. If Japan issues too much new debt to fund Takaichi's ambitions, it could overwhelm market demand. This risks a disorderly bond market sell-off, which would spike borrowing costs across the entire Japanese economy and could even trigger global financial contagion. This leads to the central question: what's the real endgame here? Takaichi's decisive win means she no longer needs to bargain with opposition parties. Her power is consolidated. The issue for investors is whether this will prompt her to expand her stimulus ambitions or lend her the political cover to proceed more cautiously. Paradoxically, her massive victory might actually give her the political capital to be more cautious than the market expects. This is the ultimate test of her fiscal credibility. Will she double down on stimulus, or will she use her power to focus on long-term stability? A cautious turn could trigger a complete reversal of the Takaichi trade, strengthening the yen and stabilizing bonds. Prime Minister Takaichi's victory has given her an undeniable mandate, but it has also forced a high-stakes choice. She now stands at the centre of a monumental economic conflict, a decision between fueling a historic stock market boom and confronting the nation's massive debt. The Takaichi trade is now in full effect, and global markets are watching to see which side will break first. So what should we watch for next? Keep an eye on three things. First, the yields on Japanese government bonds for any signs of a market crisis. Second, the yen exchange rate for potential government intervention. And third, the results of the upcoming Shunto spring wage negotiations. And this is critical. Without sustainable wage growth for the average worker, this stimulus could fail to boost the real economy, trapping Japan in a cycle of high inflation and low growth. We just mentioned the ghost of the UK's Trussonomics crisis. And speaking of costly UK economic policies, another major challenge is brewing in the industrial sector. The UK government is burning through more than £1.2 million a day to keep a single company, British Steel, from collapsing. Now, get this. This staggering daily cost isn't just a bailout. Economists are starting to call it a national security premium. It's a quantifiable price a country is willing to pay to maintain control over its critical industries. This case sets a precedent, testing just how much Western governments will spend to reshore strategic sectors, not just steel, but potentially semiconductors or energy in the future. This crisis ignited when its Chinese owner Jingye rejected a government support package and threatened to shut down the Scunthorpe Steelworks. The government stepped in, taking emergency control to save 4,000 jobs. Interestingly enough, this was possible because of a special law, the Steel Industry Special Measures Act, passed specifically to give the government the authority to seize control when national interest is at stake. However, this is where the situation takes a more complex turn. Jingye is still the legal owner of the plant, and according to reports, they are demanding as much as £1 billion in compensation to walk away from the loss-making operation. This demand is significant because it might signal a new playbook for state-linked companies exiting strategic Western assets. It appears to be a move to use political leverage to maximise financial returns on what is otherwise a failing business. The outcome of this negotiation will be watched closely around the world, as it could set a global precedent for how countries handle disputes with firms from strategic rivals. For Chinese companies looking to invest overseas, this case highlights potential political risks and could influence future investment strategies. The financial drain is staggering, with the bill already topping £359 million, but that's not the only alarming number. The UK's total steel output has plummeted to its lowest level since the reign of Queen Victoria, turning this corporate crisis into a matter of strategic national importance. As one analyst put it, if you want to keep blast furnaces, if you want to keep rail supply, then it's going to come at a cost. The government is now caught in a high-stakes standoff. One veteran metals executive states bluntly, if we've got to import everything we can be held to ransom, it does need to be protected and we need to accept the cost of that. This highlights the core conflict, the massive financial burden versus the strategic liability of relying on foreign suppliers in a time of trade wars. A proposed solution involves shifting to cleaner, more efficient electric arc furnaces. The solution centres on electric arc furnaces, or EAFs, which work very differently. Instead of making steel from scratch using iron ore and coking coal in a blast furnace, EAFs use massive amounts of electricity to melt down recycled scrap steel. The environmental benefit is huge, potentially cutting carbon emissions by as much as 75%. The problem is, this modern technology requires far fewer workers, putting thousands of jobs on the line and creating a political firestorm. This is a perfect example of what's known as the green transition trap. It's a direct conflict between achieving climate goals, ensuring labour stability, and maintaining national security. By moving completely to EAFs, the UK might lose its sovereign capability to produce virgin steel from raw materials, a critical capacity in times of crisis. A union representative warns, Our members on site have tolerated more than enough uncertainty. However, this shift also presents a fascinating opportunity. It reframes domestic scrap metal from industrial waste into a strategic commodity. The UK is a major exporter of scrap metal. By using this resource at home, it could insulate its steel industry from the volatile and geopolitically sensitive global markets for iron ore and coking coal. It's a unique strategy where circular economy principles become a tool for national resilience. With officials privately admitting it could take 4 or 5 years before British steel is out of government hands, this bailout is shaping up to be one of the longest and most expensive industrial rescues in recent memory. The key things to watch now are the negotiations with Jingyei, which will signal the future of foreign investment relations, and the government's final decision on the electric arc furnace transition, which will define Britain's industrial and climate strategy for decades to come.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.